At first, this topic appears daunting, but it shouldn't be. All we're trying to do is to value inventory and verify that inventory exists by way of a stock take. Remember, in an earlier topic we examined briefly the two inventory recording methods, the periodic or the physical inventory method and the perpetual inventory method. The principal difference is this: in a business using the periodic method, they do not record the cost price at the time of the sale of the inventory. The reasons for this are many, but simply could be that the inventory is too small to accurately identify, there is a huge turnover of inventory items, and the value of each inventory is very low. However, the business does accurately record all purchases and performs a stock take at least once a year to determine the cost of goods sold. A business using the perpetual inventory method does record the cost price of all inventory sold at the time of the sale. The next thing we need to understand is that the value of inventory depends on the inventory valuation method used. Accounting standards let us choose between a number of different ones, such as first in, first out, FIFO, last in, first out, LIFO, average cost, and specific identification. In this topic, we will learn how each of these valuation methods are calculated with the inventory recording methods of periodic and perpetual. The inventory valuation method will help us determine the cost of goods of inventory on hand. Also, it is necessary to consider other matters when determining the cost of inventory on hand, such as goods that we may own but do not have on hand yet, and goods that we have on consignment. The Incoterms of EXW and DDP will be looked at as an example of how the choice of commercial agreements of buying and selling goods and the contractual terms used may affect the accounting definition of inventory on hand. Much later, in another accounting unit, we will introduce the Australian taxation law and see how that impacts on inventory accounting valuation. But for now, we will leave tax law out of this unit. Finally, in this topic, we must also consider inventory that may have gone out of date and now needs to be sold at a lower than cost price, and to consider any additional selling costs to help move the old inventory.